In 1988, Warren Buffett spent $1.02 billion buying Coca-Cola stock. And then he did something that most investors find absolutely impossible. He sat there for 37 years. That single decision to do nothing turned $1 billion into over $25 billion. Today, I'm going to explain why inaction is the most profitable and most underrated skill in investing. Welcome back to Daily Investor. Every day on this channel, we study the principles that separate successful long-term investors from everyone else. And today's principle might be the most counterintuitive one of all, the idea that doing less actually makes you more. We live in a world that rewards activity. More trades, more screens, more information, more decisions. But the greatest investors in history built their fortunes by resisting that urge. Let me show you exactly how that works, why it works, and how you can apply it starting today. Here's a number that should stop you cold. According to Dalbar's quantitative analysis of investor behavior, over the 30 years ending in 2023, the S&P 500 returned an average of 10.2% annually. The average equity fund investor? Just 6.8%. That's not a small gap. On a $100,000 portfolio over 30 years, that difference means ending up with roughly $735,000 instead of $1.8 million. More than $1 million gone. Not because of bad stock picks. Not because of a market crash. Because of activity. Buying and selling at the wrong times. Chasing what went up last quarter. Panic selling during downturns. Every trade has costs, commissions, spreads, taxes on short-term gains. But the real cost isn't financial, it's psychological. Every time you act, you introduce another opportunity to be wrong. And the research is clear, the more frequently investors trade, the worse they perform. A famous study by Barber and Odeen at UC Davis looked at 66,000 brokerage accounts between 1991 and 1996. The investors who traded the most earned an annual return of 11.4%. The ones who traded the least? 18.5%. Doing less literally doubled their performance. 3 o'clock. Warren Buffett once said his favorite holding period is forever. And he means it. Let's look at the actual record. Buffett bought shares of American Express in 1964 after the salad oil scandal crushed the stock price. He still owns them 62 years later. He bought Coca-Cola in 1988. Still owns it. He bought Moody's in 2000. Still owns it. Washington Post, he held that for over 40 years before it was sold. But here's the part people miss. It's not that Buffett never sells. He does, when the thesis breaks down. He sold his airline stocks in April 2020 when COVID fundamentally changed his assessment of the industry. He sold IBM when he realized the competitive moat wasn't what he thought it was. The key is that his default is inaction. He doesn't sell because a stock dropped 20%. He doesn't sell because some analyst downgraded the company. He sells when the business itself changes permanently. And that happens far less often than you'd think. Think about what this looks like in practice. Buffett's Coca-Cola position generates roughly $736 million per year in dividends alone on an original investment of $1.02 billion. His cost basis is so low that the dividend yield on cost is over 70% annually. That's the power of sitting still. You can't get that result if you sold when Coke dipped during the new Coke disaster. You can't get it if you traded in and out chasing quarterly earnings. You only get it by doing nothing for decades. 5:30. If inaction is so profitable, why doesn't everyone do it? Because human beings are wired against it. There's a concept in behavioral psychology called action bias, the tendency to prefer doing something over doing nothing, even when doing nothing is the better choice. It shows up everywhere. In soccer, goalkeepers who stay in the center during penalty kicks save more goals than those who dive left or right. But goalkeepers almost always dive. Why? Because standing still feels wrong. It feels passive. If the ball goes in and you didn't move, you look foolish. But the data says staying put is the better strategy. Investing is the same. When the market drops 30%, every instinct tells you to do something. Sell. Hedge. Move to cash. During the COVID crash in March 2020, the S&P 500 fell 34% in 23 trading days. Investors pulled $326 billion out of equity funds that month. And then the market recovered nearly everything within 5 months. Those who did nothing, who simply held, were back to even by August. Those who sold in panic locked in devastating losses and then had to decide when to get back in, which most people get wrong too. Charlie Munger put it perfectly. He said the big money is not in the buying or the selling, but in the waiting. And that's not just philosophical. It's mathematical. Compound interest needs time to work its magic. Every time you interrupt it, every time you sell, take profits, rotate into the hot sector, you reset the clock. You pay taxes, you pay fees, and you lose the exponential curve that was building in your favor. 745. So how do you actually apply this? 3 practical principles. First, raise your bar for action. Before you make any trade, ask yourself, would I be comfortable if the stock market closed for the next 5 years and I couldn't sell this? Buffett uses this exact test. If the answer is no, you probably shouldn't own it in the first place. If the answer is yes, then short-term price movements are irrelevant. Second, build a portfolio you can forget about. This means owning businesses with durable competitive advantages, strong balance sheets, and management you trust. Think about it this way: if you owned a profitable apartment building, you wouldn't sell it because someone offered you 15% less than you paid last year. You'd collect the rent and wait. Stocks in great businesses are no different, they're ownership stakes in real enterprises generating real cash flow. Third, limit how often you check. This one is simple but powerful. A study by Shlomo Benartzi and Richard Thaler found that investors who checked their portfolios daily had a dramatically higher chance of making emotional trades than those who checked quarterly. The information itself becomes the problem. Buffett famously doesn't have a Bloomberg terminal on his desk. He reads annual reports and thinks. That's it. 10 o'clock. Here's the principle I want you to take from today. In investing, the money is made in the waiting, not in the doing. Every great investment in history looked boring for years before it looked brilliant. Coca-Cola was boring for a decade after Buffett bought it. Apple was overvalued at $40. Amazon was just a bookstore for years. The investors who made fortunes from those companies did one thing brilliantly: they sat on their hands and let compounding do the work. The best investors aren't the ones making the most moves. They're the ones making the fewest. Your greatest edge in the market isn't a better screener, or faster data, or a hotter stock tip. It's patience. And patience, unlike everything else in the market, is completely free. This is educational content, not financial advice. Always do your own research and consult a qualified financial advisor before making investment decisions. Past performance does not guarantee future results. If this changed the way you think about your portfolio, hit subscribe. We put out a new lesson every single day. And I'd love to hear from you. What's the longest you've ever held a single investment? Drop it in the comments. Tomorrow, we're breaking down how to read a balance sheet in under 10 minutes, one of the most practical skills any investor can have. I'll see you then.